And in our top business story, the UAE economy is expected to grow at around 5% this year, according to statistics contained in a new report by global credit insurance provider Coface. The company also explained in its annual UAE Panorama report that the UAE country assessment has been ranked at A3. Coface uses a 7-level ranking system in ascending order of risk between A1 and D. The UAE business climate, which measures corporate risk, considers a number of factors such as the availability of company reports and the reliability and the effectiveness of the legal system, also being assessed by the company at A3. The report stated that after contracting around 5% in 2009, the UAE's economy gradually recovered, recording solid growth rates with 5.2% witnessed in 2013. Other factors that have contributed to the country's higher ranking include the favorable refinancing terms given to Dubai's maturing debt earlier this year, as well as the introduction of regulatory measures by the authorities aimed at avoiding another property bubble. Additionally, the report stated that the introduction of the new companies law, bringing gradual reforms to corporate governance, is also seen as major progress. While the report noted that the UAE economy was still heavily dependent on revenues from the hydrocarbons sector, moves to diversify the economy, particularly in Dubai, was seen as favorable to investment, with the report acknowledging in particular the retail and tourist sectors, which are the fastest growing industries in the UAE. Leisure tourism is among the driving trends of the hospitality industry, according to experts. Travellers want to know in advance what they will be doing or experiencing when planning a trip. This has grown massively that in 2013 the leisure show was launched and is now running alongside the hotel show. This year it saw a 60% growth. Guy Wilkinson, a managing partner at Viability, a specialist hospitality and real estate consultancy in Dubai, says this is an opportune time to build more leisure places as demand and expectations continue to run high in growth market, including Dubai.
If you look at Dubai as an example of a market, a hotel market in growth or a tourism market in growth, and you look at something like Expo 2020, which is in basically a large patch of desert at the moment, which now has an airstrip in it and an airport terminal. Around that, they're planning to grow a 140 square kilometer airport city. Actually, they're calling it Aerotropolis. And so, that's part of that has got to be done by 2020. The rest of it will be done by 2040 or something like that. Dubai Land, which was started back in the early 2000s, got, shall we say, stuck in the global financial crisis. That has to continue now to its full extent, which is almost the same area as the city of Dubai. We'll be out in the desert full of theme parks and residential estates, etc. So there's a long way to go.
Another visible trend at present, according to experts, is the rise in mid-range properties as well as the effect of social media. Courtyard by Marriott and Marriott Executive Apartments DIP General Manager Andre Saad says properties need to adapt to the changes in technology, listen more to what guests have to say and respond better to ensure sustainability and customer satisfaction. While the Senior Vice President and Director of Hospitality Design at HOK, Julia Monk, says it's only a matter of time before it takes over the hospitality industry.
90% of the travel decisions in China are influenced by social media. So when people are planning on going someplace, the first thing they're going to think is, oh, I'm going to check the social media and what everyone else thought about this property before I make my reservation, before I make my plan. It's almost a reality check, a virtual reality check for everyone to have a better idea of what to expect and what to anticipate before they make their travel plans. That ultimately affects how we're designing our spaces because we want to be able to meet and exceed the expectations of the guests when they arrive. So it's all one big circle of design, living, and experience that we're all involved in.
Marriott have been one of the pioneers to introduce the mobile check-in, and this is something that have been done live a couple of months back. So we already started receiving people that are checking into the hotel through their mobile phones, and everything is ready for them, everything would be prepared, and then the constant communication between the hotel and the traveler is done, on the spot without any delay. The second thing is we are developing, according to the brand as well, any demand that, from an IT perspective, any requirement that is done. So we have to comply within these specific minimum requirements in terms of IT. And this is something as well that the Continent Office have came up with.
The US dollar continued its strong run last week, closing higher against its major counterparts. The Japanese yen fell to its lowest level since August 2008, while the euro also traded near 22-month lows. Early in the morning, the New Zealand dollar dropped to a one-year low as the Reserve Bank of New Zealand hinted that they would sell more currency. The moves have weighed down the Australian dollar, which also sunk to a 7-month low. With a packed week ahead, we spoke to Gaurav Kashyap, the head of futures at Al Pari Middle East, to get his views on the US dollar.
Well, the US dollar closed the week again on a strong note as higher-yielding assets sold off as a result of weakening economic data. Now, what we're expecting to see in the week ahead is continued US dollar strength. We're particularly going to be watching the performance of the euro. We have a very, very big week for euro data. We have inflation data coming out on Wednesday. We'll see how that comes in line with the expectations of 0.3% or slightly lower. It could fall to 0.2% or it could be in line with 0.3%. Of course, this is followed by the all-important rate decision by Mario Draghi and the ECB on Thursday. Now, definitely an interest rate cut is definitely off the table. We've seen them cut rates twice in back-to-back months in the past 2 months. We expect them to keep rates, the benchmark rate, unchanged at 0.05%. with the main deposit rate at minus 0.2%. Now, what that means is we could see more lingo and more talks with regards to future asset purchases. We could see the ECB balance sheet increasing back to around 1 trillion euros in asset purchases. And of course, if this is announced, this would weigh down the euro very, very heavily. Now, if you look at the positioning of the euro, the net longs in US dollars have increased, which means this opens the door towards a move of maybe 1.25 for the euro USD. But overall, the US dollar will continue to remain well bought in the week ahead and the weeks ahead. Also on the calendars, of course, the US non-farm payrolls. Once again, this will not be that big of a market mover. We will keep our focus and attention on the ECB speech on Thursday.